Hey everyone, it is Jay Soloff from Investors Alley, and this is our trade of the week. So we're going to look at something interesting going on with unusual options activity, and then we're going to pull up a brokerage account and show you how to actually make that trade for yourself in case you wanted to do it. So I'm looking here, Market Chameleon. I'm at the unusual option volume page, checking out what was going on in terms of unusual option volume. So if I sort it by volume, I can see some of the more actively traded names were today. And if you look, you can see SPY, QQQ, IWM. These are the three most traded ETFs out there for the most part, and there was a ton of action today. And the reason that was the case is because it was a down day. We haven't had a down day in a while. There is concern over the coronavirus in China that is actually spreading and is highly contagious. So there's concern over that and how it might impact the economy. So the market's been selling off a little bit. So that's why you're seeing this action here in some of these really large ETFs. So let's just look at one of these. We'll pick QQQ, which is the Nasdaq 100 ETF, heavily traded. Traded over 1 million options today, and it's very relevant these days because most of the biggest stocks now in terms of market cap are in the Nasdaq 100, and that's what this tracks. So if we look at the trades here, we'll pull up a list and then we'll sort it by volume to see what sort it by quantity, because we want to see what some of the really big trades may have been. All right, so this should pull up here in a second and we will take a look. There we go. So as you could see right off the bat, a lot of put trades. So there's probably a lot of hedging activity today, maybe some speculative trades on if the market sells off here in the coming weeks, but that's generally more hedging than speculating, but you never know. So here's some kind of interesting spread that happened right off the bat with quite a lot of volume. It looks like a put. So my guess is that rather than a spread, rather than looking at this as a spread, this is probably a roll trade, seeing that there's a ton of open interest in one and almost nothing in the other. So it looks like someone took a lot of puts that were at the 203 strike in February. So February 21st expiration. Now here, this is when the stock is at 224. So 203 is pretty far out of the money. Someone may have wanted to make their hedge a little bit more relevant. So looks like they closed over 21,000 of these. They paid 38 cents. And so they sold them out. So these were long and they sold them out. And then they bought new ones, not quite as many, probably because the price is quite a bit higher. But they bought about 16,000 of these at the 210 strike. So they raised it by 7 strikes to a more relevant strike should the market really sell off. So this is, again, this is almost certainly a hedge, probably looking at a certain distance from the stock price that they wanted to be protected, and they moved it to March. So they gave it, another 2 weeks. So maybe their model showed that they wanted to be protected for a little bit longer, and that 203 wasn't relevant enough, so they went to 210. To the 210 strike, they paid 136. So they spent almost $2.2 million on this trade, although they sold this other strike and got back 800,000. So they spent about $1.3 million on this. This won't start paying off until you get under 210 minus whatever they paid. If you look at these together, it's about $1. I'm sorry, here. If you look at these together, it's about $1 for it. Looks like about 209 is where you're talking about the payoff starts for this. But the most they can lose is the premium, which again is, if you look at it, it's about $1.3 million. So looking at this, let's take a look at how you might want to put this on here. So QQQ, if we go to that March 6th, And you can see here's the strike. You can see by all the volumes, over 16,000. Most of that was from this one trade. And it already has gone up quite a bit because this was done at 224 and it closed at 222. So already this trade is paying off. They spent about 140 and it's already up to about 180. But if you wanted to make this trade, it's as simple as just paying the ask on this. If you wanted to just you could try to make your price somewhat closer to the mid market, maybe lower it a couple cents. But in this broker, you just click on it, it brings it down here. Your March 6, so you want to buy a 10 lot, you want to try to get somewhere in the mid market price. So let's say you do 182 or you do 181 or something there to see if you can get filled at a little bit better price. It's still pretty narrow. It's only a 5-cent market, so you're not losing too much in edge. And then you send it in and it will show you basically that your max profit, because if there were to, obviously QQQ is not going to zero, but that's what technically it would look like. The most you could lose is what you pay for it. And that's that. You send it in and wait to see what happens. So that's how you would want to make a trade if you're looking at doing a sort of a out of the money put for protection against Nasdaq stocks.